Rising prices have prompted companies to become more careful about technology spending, hurting prospects for the tech stocks that outperformed other market sectors year after year. Now Microsoft and its peers are taking stock. In July, Microsoft said it will trim less than 1% of employees, and in October it confirmed an additional round of job cuts that reportedly affected fewer than 1,000 workers. "I'm confident that Microsoft will emerge from this stronger and more competitive," CEO Satya Nadella told employees in a memo that was posted on Microsoft's website. The move will reduce Microsoft's head count by less than 5%, and some employees will find out this week if they're losing their jobs, he wrote. Microsoft shares moved modestly higher at the U.S. Open after the announcement. The workforce adjustment will hit all teams and geographies, with more impact coming to sales and marketing than engineering, a company spokesperson told CNBC in an interview. Employees in the U.S. who are eligible for benefits will receive severance that's above the market and 6 months of health care and stock vesting, along with 60 days notice before their work ends, Nadella wrote. Nadella reiterated trends in the business climate that he has described in recent months. As we saw customers accelerate their digital spend during the pandemic, we're now seeing them optimize their digital spend to do more with less, he wrote. We're also seeing organizations in every industry and geography exercise caution as some parts of the world are in a recession and other parts are anticipating one. Earlier this month, Nadella had indicated the company might have to institute changes. "I think for us as a global company, we're not going to be immune from what's happening in the macro," he said in an interview with CNBC TV 18. "We will have to also get our own sort of operational focus on making sure our expenses are in line with our revenue growth." Microsoft has called for 2% revenue growth in the fiscal second quarter, which would be the slowest rate since 2016. The layoffs are not a major surprise given the deterioration in Microsoft's cloud infrastructure and Windows operating system sales over the past few quarters, said Gil Luria, an analyst at D.A. Davidson who has a buy rating on Microsoft stock. Investors are very concerned about the margins of many technology companies, including Microsoft, he told CNBC in an interview. "I think there's been a broad expectation from all these companies, especially the ones that hired more over the last 2 to 3 years, to adapt and react to a slower growth environment and show the discipline and the focus on shareholder value that investors need to feel right now as they try to ride out a slower growing economy," Luria said. The culling might save Microsoft around $2.5 billion over the next 12 months, or 14 cents per share when including the charge, analysts at Evercore ISI, who have the equivalent of a buy rating on Microsoft stock, wrote in a note to clients.